Is it time to start worrying about your mortgage? Hey everyone, welcome back to the Vancouver Life Real Estate Podcast and YouTube channel. Today we are talking about the big Bank of Canada announcement, and to help us with that is a senior mortgage specialist with the Bank of Montreal, Mychal Ferreira, who is joining us today alongside Ryan Dash and myself. So it'd be hard not to have heard it, but yes, on April 13th, the Bank of Canada increased their overnight rate a full half point. This is the first back-to-back increase that they have done, because they did do a quarter point at the last announcement a couple months back. First time they've done back-to-back since 2017, and the first half point increase we've seen in 22 years. Obviously, this is going to have some impact, and people are asking questions. Most buyers haven't been in an increasing interest rate environment in many years. So we're here to kind of give the lay of the land, see what's really going on, and see if it's time to worry or if everything is going to be okay. So while this increase was wildly expected, it came with some pretty strong forecasting into what might happen next. So much so, I think I'll best suit this by actually reading the quotes directly. So here they are. CPI inflation is now expected to average almost 6% in the first half of 2022. This comes from Tiff Macklem, the governor of Bank of Canada, at the announcement, and will remain above the control range throughout the year. It is then expected to ease to about 2.5% in the second half of 2023 and return to 2% in 2024. So they think it's going to take a full 2 years for inflation to come back down to their target 2%. And they're going to raise rates to help make that happen. Price spikes in oil, natural gas, and other commodities are adding to inflation around the world. Supply disruptions resulting from the war are also exacerbating ongoing supply constraints and weighing on activity. These factors are the primary drivers of a substantial upward revision in the bank's outlook for inflation in Canada. Again, all they're doing is pointing fingers. It's that fault. It's their fault. It's that fault. No mention of them printing 25% new money into the system in the last 2 years. That had nothing to do with it. Okay, fine. But this is where it gets interesting. They are now expected to add an additional 50 basis point hike in the next announcement in June. I believe it's June 1st. And then maybe even another one in July. This will bring the overnight rate up to 2%. Okay, and we're coming off of 0.25%. And maybe even they're forecasting already another 50 basis points in 2023, bringing it up to around 2.5 to 2.75, which they call the upper end of their neutral range. This is about 1,100% increase since where we started at 0.25 just earlier this year. Okay, lots to take in there, but let's dissect it. Everybody, please let's welcome Mychal Ferreira. He is a senior mortgage specialist with the Bank of Montreal. Him and his team have done over 600 mortgages in just the last 2 years alone. So this person is very well qualified to tell us what is happening in the mortgage world. Mychal, with that type of volume and having that announcement on the 13th, what was your day like on the 14th?
It was anytime there's a change in rates, up or down, you're going to see, a lot of traction and a lot of conversation. But what we haven't been used to for some time now is an upward rate increase, right? So, the first one was a quarter point, and that was a good time to kind of re-educate a lot of people on how variable mortgages work, who's affected, who's not. There seems to be just general confusion about, does this affect me? If you're in a fixed rate mortgage, you got nothing to worry about. Everything stays the same. If you're in a variable mortgage, and there's several kinds, every lender has, a specific kind of variable mortgage. But in our case at Bank of Montreal, we do a variable closed mortgage, which essentially the day you set up your mortgage, your payment stays the same. The difference is your principal and interest shifts more towards interest. So, as this news comes out, it's just kind of letting people know, like, first of all, does it affect them? And if so, how much? And, yesterday, obviously, that was a pretty aggressive increase. And, we all saw it coming. And I've been telling my clients for a very, very long time now, like, It's not a matter of if, it's when and how much, right? And we've been on that gravy train of low rates for a very, very long time. And, it was brought on by a pandemic. So it's not normal, right? And so, one of the things that I kind of look at when I talk to clients that have been reaching out. But yesterday, before noon, I had about 130 emails regarding this. So, spent the better half of the day just trying to stay on top of that, letting people know what to do, letting people know where they're at. One of the things that we started implementing at kind of the lowest time of when rates were very, very low, is we started telling people that, like, look, like, if you're on a fixed income and every dollar matters, I would go fixed, because you can't afford a change, right? And a change could impact you, right? And the people who had a little bit more cash flow, or perhaps this was an investment property, I would say, look, you have the ability to increase your payment to offset those increases. And a lot of times people see these numbers and they don't know what it means, right? And just one of the things I do when I send an approval is I show people, okay, well, here's your rate, here's your payment, right? And a quarter point does X to your payment. So as you see rates go up, expect it, right? But go in and use your prepayment privileges that you have, which in our case, you can increase your monthly payment by 20% and also do a lump sum by 20%. You can just bump up your payments and keep your mortgage amortization in check. So one of the, like, for example, I have here a $500,000 mortgage. When prime was 2.45%, your discount was 1.16%, which was a average rate of 1.29%. Those were the heydays, right? Your monthly payment was about $1,674. A quarter point meant that you went up to about 1734, right? And then another quarter point, 1794, another quarter point, 1855. So by laying it out like that for people, it puts a number to a payment that they can understand, but also knowing that, look, like, at the end of the day, in our case, you don't have to change this, but it doesn't hurt to, right? And that's what the prepayment privileges are for. And I would typically say, for people who own, this is for their residents, I would start increasing their payments, right? And they got a head start from the fixed, right? Fixed rates are at the lowest. We're in the twos to the mid twos, and then as of right now, they're peaking at over 4% right now. So lots of changes.
Wow. So Mychal, so people understand correctly then, your fixed payments, they don't change, right? So you're locked in for the duration of that term. So if you've got a 25-year amortization period, typically you've got a 5-year fixed rate, right? So nothing really changes, except where are we in 5 years from now? That's
besides that point,
yeah, because anyways, we'll touch on that in a little bit. But so to understand a closed variable mortgage, meaning if I've got a $2,000 payment, and in the last year, I've been paying, let's just for simplicity, $1,000 has been principal and $1,000 has been interest. You're telling me that $2,000 payment isn't going to change. However, I'm paying substantially more interest than I am principal. So therefore extending the length.
Amortization. Yeah. The life of the mortgage.
The life of the mortgage, right. So it's going to take me longer to pay that off as a result of this going up. So effectively, it does cost you more money. It just doesn't hit you monthly. Well, it does. It does. It's just a different use of your cash flow. Yeah.
So then, you look at the global TV and the CBC, whatever, the news, they're all saying, okay, well, payments have all gone up, on an $800,000 mortgage by $200 a month. What is that in reference to? Who are they trying to scare?
So, if you have a line of credit or an adjustable rate mortgage, so basically those are the ones that will be impacted immediately. So if you have a HELOC, a home equity line of credit, your payment is now fully dependent on prime, right? So prime goes up, your payment changes immediately, right? And it's usually an interest-only payment and it changes overnight. But some adjustable rate mortgages, typically, I know through the broker channel, alternative lenders, they just adjust your payment for you, right? So it comes down to understanding the product at the beginning to make sure that, look, like, you're prepared for that, and it will change on you. But I do understand that 4 of the 5 banks have these closed types of variable mortgages where the payment you set up from funding is the payment that goes through the entire life of the mortgage unless you change it.
Right.
But it will, push your amortization out, your life of the mortgage out. What ends up happening is if you just kind of turn a blind eye to it in 5 years, you go to renew, well, you now owe all these extra years of principal. It's going to balloon your payment, right? So that's why I've always taken the strategy to explain to people that, look, you don't necessarily have to increase your payment by every dollar that it's being increased, but a $25, a $50, $75 increase a year will have an impact in 5 years, right? And any sort of increase is gonna help you. The problem is I would say that 9 out of 10 people don't do that, which is everyone's scared, but they're not doing anything about it, right? And it comes down to, of course, are you in the right mortgage for your situation? So those are things that when you are getting a mortgage, you need to see and understand, especially nowadays, right? Because now it's up in our face. But when rates are 1.29% for a variable, of course that's the most attractive option, right? So,
yeah. Would you say a couple of things? So before I go on, first of all, my wife came to me last night, heard about the basis point increase, and was like, Ryan, we should lock in. We should just be locking in. And I'm going, whoa. So as a variable rate mortgage holder, I'm looking at the 5-year fixed rates now. And if I look at that versus say where I was at 1.29 and now looking at almost a full, 100-point basis hike here, it's still much cheaper to be on the variable side than it would be to be on the fixed side. So explain to people, maybe, because some people will have the option to lock in the current fixed rate under their variable, but can you explain to people how that works?
So in our case, you're allowed to convert your variable mortgage into a fixed term for equal or greater term at any point in the mortgage with no penalty. So what that means is if you take a 5-year variable, you're a year in, you can fix for 4 more years. I'm not a huge fan of that because, look, at the end of the day, it's just a payment, right? And going from variable to fixed just does what? It just changes your payment. So why not just change your payment versus jumping into a fixed, right? And play the slow roll up. Yeah, we know it's going to go up, but it's not going to go up today. It's not going from 2.4% variable with your discount to 3.89% tomorrow. Right. You're instantly committing to this massive increase overnight. And to give you an idea, again, $500,000 mortgage. If you're at today's average discount, you're looking at about $1,980, right? But you're like, I'm scared, rates are going up, I'm in a panic, I want to fix. Well, now you're going to go to 3.89 and your payment's going to go to about $2,350 overnight.
Wow. Yeah.
Right.
Yeah.
And I'm just not sure that I'm, first of all, I don't think they're going to get that far with this. I mean, it's personal opinion. With all the mortgages that I've done and I see the spreads, I know that everyone in the city and does what they can to get into the housing market. So it's not like everyone has a ton of extra cash, right? And I think that they're overshooting this thing, right? So I would say, if you know that your threshold is that 4% ceiling anyways, and you're willing to commit to that right now, well, then, play it all the way up, right?
It's safe to say, though, in a variable rate, and we'll get into whether or not they're going to overcorrect in a minute here. But variable rates can go back the other way, right? And people forget that, right? Yeah, we're in an interest rate hike environment. We've got inflation to deal with, sure. But maybe, if you're in a 5-year variable and you go up for 2 of the years, but you're back down for 3 of them, well, then, you really kind of shoot yourself in the foot if you fix that rate, as opposed to, like you said, just budget for, if you can, budget for those additional dollars, right?
Absolutely.
Okay, some really good advice there for sure. Now let's look at people that might be renewing in the next 12 to 18 months, and they've just been given this forecast that, look, we should be upwards in the 2.5 overnight rate within that time frame. What's the advice to those people?
Now is the time. Talk to your person, your mortgage person, whoever that is, it is absolutely the time to be exploring that. It has been the time for the past 2 years to have that conversation, but more so now, because if you have a fixed rate that has a year left, or 18 months, or even a variable that maybe is a bit dated, it's a good idea to see if you can extend your term now, because fixed rates are, they're based on the 5-year Canada bond yield, right? And I check it daily, and it's still creeping up. So I think fixed rates will continue to get bumped up. So I and variable rates, as we know, the discounts are shrinking and they're going the other way, right? So I don't think time is necessarily on your side. If you have a renewal pending for next year, it's good to see, well, what's your penalty. The one good thing about increasing interest rates is it kind of converts fixed rate mortgages from interest rate differential penalties, IRD penalties, to 3 months interest. So I've seen a few examples where a year ago, they had a $20,000 payment, but now they have a $4,000 payment, prepayment to break out of the mortgage. So that is the one benefit of increasing rates, is it does reduce penalties. So absolutely, now is the time. Have that conversation, reach out to someone and explore it. Worst case scenario, you leave it the way it is. Best case scenario, you save yourself several $1,000s, right? So why wouldn't you?
Yeah.
Makes sense. Okay. Now, what about people that, let's say, bought into a pre-sale project and they're completing within, let's say, 3 years, and they're seeing interest rates going up, and they're starting to wonder what the best move is? What do you advise to someone in that scenario?
So actually, we're lucky at Bank of Montreal that we have a very, very nice looking program for builder deals. So any project completing within 3 years, we can do a full approval today with your appraisal. Actually, to be honest, that is probably one of the most key components of locking in an approval now, because if you're buying a pre-sale or have bought a pre-sale, arguably in the last year or 18 months, you probably bought it at an elevated price, right? Prices have been going up, right? And there's a chance that in the next 2 to 3 years, we're going to see an adjustment down, whether that's, a few percentage points, but you don't want to be short any number of dollars when you come to completion because of that, right? So by getting an approval now, we lock in today's value, securing that, look, this is the minimum down payment you're going to need, no surprises there. But we also cap a rate for you, right? And that rate basically creates a ceiling of protection. So like in the worst case scenario, you know that your payment is going to be X, rather than crossing your fingers and hoping that it doesn't continue to go up. And now you're maybe just a little bit out of reach. But not only that, maybe you don't qualify then because the rates have gone up so much, and qualifying terms have changed. So I always advise people, look, if you're within that 3-year bubble, take the time and explore an approval today to protect yourself. I mean, you're putting in a 10 to 20% deposit. Protect it.
Yeah.
So
Makes sense. Okay. And then for the, I guess, last scenario, what are you advising today for people that are thinking about buying a home in 2022?
So, again, it comes down to individual situations. Again, what I do, I show you the differences between variable and fixed. I show you what the worst case scenario is. And, if you are scared of where the world can turn and scared where rates can go, I would say, go fixed. But if you have a little bit more, cash flow and you can afford it and you are prepared, I would say go variable. It really comes down to the individual situation. But myself, and historically, variable has still always been the play. It's yet to be seen if it will be moving forward. But if you look at, all the historical prime rate changes, this isn't the first time rates have gone up. They've gone up quite a bit. Pre-COVID, they were at 4%. People forget that, right? 3.95. And variable was still the play then, right? So I'm still leaning on the variable side a little bit. So.
Mychal, would you say that? I mean, I think it's probably true that the vast majority of people shopping for a mortgage are primarily rate sensitive, right?
Yeah.
But this might be kind of an opportunity to say, like you talked about, where maybe an alternative mortgage product where you're paying maybe, a couple basis points more for a little bit more expensive product, but it gives you the nimbleness, if you will, to say, get out of a mortgage, renew at an earlier time frame so you can curb your risk in the future. Because a lot of people are like, I just want the lowest rate, I want the lowest payment. And that's not always the best thing to choose, especially considering where we are right now, right?
No, absolutely. And that's one of the things that I have seen over the last few years, when people, when we were doing fixed rates at 1.7, 1.8, 1.5, oh, well, HSBC is offering me, 1.1%. I said, okay, well, I mean, then let me see if I can match that. Like, I'll work to get you that if that's what you want. But that's where people are drawn to, those big headlines, the low rates. They want a low rate, but they don't understand the full impact of it, right? And hindsight's 2020, right? Oh, I should have taken that 1.7, and now we're at 2.5% for variable. So, it is one of those things that comes down to conversation, right? And
trusting the expert in the field.
100%. Just because it's cheap doesn't mean it's good, right?
That's right.
And generally speaking, like I still like the variable, but it's not for everyone, and that's becoming more apparent with all these changes, right? Because now, every news channel, every paper, everything is promoting a little bit of fear there, right? So you don't know until.
Well, and to that point, I speaking of fear, and I don't mean to inject a bunch of it, but I do want to talk about the trend we're seeing right now is clearly rate hike to tackle inflation. Even, I mean, the comments, not only just the rate hike, but the comments suggest that we're going to be seeing a lot more of this here for at least the foreseeable future. So if people, if I was at the start of the pandemic even 2.5 years ago now, and I locked in at a mortgage and I got a great rate, but I'm going to be renewing here in the next 2 or 3 years. And I think we're going to see probably the height of the rate cycle in those 2 years, maybe 3, depending on how it goes, but 2 for sure. And so what's going to happen to those people who are paying, they've got a 2% fixed mortgage, but now they're staring down what might be a 4% or a 5% fixed, it's going to double. It's going to, and we're talking about the value of homes has risen tremendously in that time, right? So, the payment on 5% 3 years ago is very different than the payment on 5%, 2 years from now.
100%. And I think that they will change amortizations. I mean, that's already, I'm already hearing of that from, multiple channels that they're talking 40. And it could be a complete rumor, but even 50-year amortization. Wow. I don't see that, because I'm like, that would be ridiculous. But I could see a 40-year. I mean, how else do you there's no other way, right? And I think they need to also look at qualifying, because I was telling Dan, before the stress test came in, if you took a 5-year fix, you qualified at your contract rate. I would love to see them go back to that, because look, like, you'll qualify for more, but here's your fixed rate and nothing will change, right? But what we've done with what the stress test has done is just pushed everybody into variable, especially now, because if you want to take a fixed at 3.89, you're qualifying at almost 6%, versus 5.25% for a variable.
Right.
So we're in a time now where we're actually pushing more and more people into a variable, just simply for qualifying sake.
Right. Just so they can buy.
Just so that they can get in the market, right? Yeah. So I think that, there needs to be an overhaul of qualifying, of amortizations. There needs to be a change, because, with this environment now going the other way, the status quo won't work. I don't believe it will. It will hit a point where just, either people aren't qualifying or people can't afford it. And, at least they're in tune with that. And hopefully when, they'll make those changes sooner than later.
Yeah, it was not that long ago when you could buy an investment property with 0% down and 40-year AM on it. We're talking less than 20 years ago. Some people may not remember that, or have been paying attention to real estate so much in that era. But yeah, a lot of levers that could be pulled here, because the BOC seems to kind of overextend on each end, if you know what I mean. The
Yeah.
pendulum really swings far, right? They overstimulated here with the government and the 25% money printing in 2 years.
Yeah.
And now it seems they may very well over hike the interest rates. And it's not about just, you know, calmly navigating the marketplace. It's just extreme moves on either end. And, you know, it's kind of hard to find this common ground. But like you said, there are ways for them to stimulate again, to keep housing elevated, because we know that's a mandate. When things break, because things are going to break quick and we're already seeing it. And the funny thing is too, with their timing, I mean, housing cycle was already taking a natural slowdown and it was about to calm down and prices were likely starting to dip. And then they're throwing now these huge hikes on top of it, which are just going to, you know, fuel to the fire. So we're going to see prices drop. They're probably going to drop rapidly. And then they're going to be like, oops, let's overstimulate over here again. And it's,
I mean, we don't need to look very far back to recognize that when you do look at interest rate hikes, they often work better than anticipated in terms of slowing things down, right? And so the scary thing is, you know, the scary thing is with these 50 basis point hikes, I mean, certainly the timing is off. You know, they should have been doing this 6 months ago, 8 months ago, right? Even 12 months ago. They decided to let it run hot and go with growth. But they were wrong about inflation. You know, they thought it was going to be transitory. It's proven to be far more than just that. I mean, like Dan said, there's 25% more currency floating through, right? So now they're going through quantitative tightening to try and make the value of the dollar come up. And in doing so, I think they're really late to the party. I think it'll likely be an overcorrection. And if that happens, we run the risk of going from a recovery to a recession, and pretty quick, right? So it's really, really hard to know where they're going to go from here, but I really think they should have been starting quarter point hikes a long time ago, just so people can palate that, right?
Yeah, absolutely. Space them out a bit, you know. I understand why they kept them low, but like I think taking this approach where it's just like a band-aid pull, you know, it's 50 points. Like if they do another 50 coming up, like, you know, you're turning people's, you know, lives upside down in a matter of 6 months. Wow. You know, it's just so aggressive. Right?
To that point, I was on the phone with my dad last night talking about it too. He's a realtor as well. And he was like, you know, Ryan, like back in the 80s, we had 18% interest rate hikes or interest rate. And I was like, yeah, but Dad, your home was 200 grand. And, you know, a 2% swing on 200 grand is palatable, but a 2% swing on 2 million is a very different story, you know? And that's what we're seeing here. And like Dan said, to go from a quarter point to 2% is an 1100% jump. That's really what we're talking about here. And those people who have $2 million properties making those payments are going to feel it. They're really going to feel it. And so are the businesses. Anyone who's got, like you said, a home equity line of credit, an investment property, people who are trying to get ahead, you're just going to get clipped at the feet, right?
Yeah, it was just last year. 2021 was the year that more homes sold in Canada than any other year. So a lot of people are paying attention to this, understandably. I think, Mychal, you know, we really appreciate your time today. For those who are homeowners or thinking about it or just want to know what's going on with rates, what's the best way for them to get a hold of you?
Honestly, just you can find me on Instagram or reach out to me by email or phone. Just Google search my name. Multiple ways to get a hold of me, but just reach out. Anyway, happy to have a conversation, happy to run some numbers and see if we can't save you some money.
Perfect. We'll include your contact info in the comments and info below. Ryan,
Mychal, I just want to say, for first-time home buyers, people who are looking to get into the market, does it cost anything for them to find out what they pre-approve for?
No. Honestly, costs you nothing to have a conversation. It costs you nothing to run a pre-approval, and costs you nothing to secure a rate. So really, it's a plus.
Awesome. All right, Mychal. Well, thanks so much for your advice and
guys.
for not, you know, letting me panic here. So it's much appreciated. And, you know, we'll see you on the next one.
Sounds good. Thanks, boys.